Good afternoon, everyone. Can everybody hear me? Doing, can you hear me? Welcome, Kings and Queens. My name is Wale. Welcome to the Africans Business Club. Our goal is to normalize financial literacy, networking, and sharing of ideas and collaboration amongst Africans. Before we introduce the topic today, we have some few meeting guidelines. The moderator will mute everyone's mic while the expert gives the main presentation. Once the speaker or expert is completed with the presentation, there will be time for a Q&A session. At this time, you can unmute yourself and ask questions and share ideas. You can also post questions in the chat window. Again, this session will be recorded and will be shared with everyone via email. Dami, please go ahead and introduce the speaker. Hey, Dami, you should be able to unmute yourself now.
Okay. Hello, can everyone hear me?
Yes.
Okay. Hello, everyone. My name is Dami. I am part of the African Business Club. Our financial literacy discussion topic today focuses on mutual funds versus index funds. Today, we have one expert on the call to lead the conversation by the name of Stefon Walter, founder of Finessing Finances. Finessing Finances is a platform that uses Black culture to teach financial literacy. He is also the author of Finessing Finances, a book that humorously covers personal finances. His works follow one motto: make money easy. Thank you again, Stefon, for joining us. You may please begin.
Thanks for having me. Okay, so I'm gonna go ahead and try to bring my presentation up one quick second. I would ask y'all how y'all doing. I know everybody is muted right now. I just trust that everybody's staying safe and healthy and all that good stuff. Can everybody see the screen, the presentation?
Yes.
Okay, that's perfect. Okay. So again, my name is Stefon Walters. Thanks for having me. I'm glad that y'all are able to come and accept me as I am. You know, I haven't had a haircut in a few months, so I'm roughing it out right now. So I'm coming to you from a do-rag, trying to keep it as authentic as possible. But today, as you know, we're going to talk about mutual funds and index funds. So we'll have a pretty good topic about it, pretty laid back, and, you know, hopefully y'all can leave here with some extra information, or at the very least, a little bit more questions to get you thinking about it. And again, you know, my name is Stefon Walters. I'll show this information at the end, but, you know, here's my social or email. If, you know, after the program, you want to reach me, you have any more questions or anything of that nature. So to begin, so the first thing that's important to understand when it comes to mutual funds and index funds is, you know, exactly what is a fund. And I think once a lot of people grasp the concept of what a fund is, then, you know, it starts making a lot of sense. So as some of you may know, when it comes to investment, there's a lot of different types of investments. You know, you have your stocks, you have your bonds, you can invest in real estate. Like, you know, it's never just one clear thing that you focus on when it comes to investing. And so the goal of a fund is to basically take all the thinking out of investment. And so one way I like to think about it is, you know, if you picture an Easter basket, for example, you know, if you have an Easter basket, it has a lot of different items in it. You know, it has different types of candy. You may have toys, you may have, you know, whatever in it, but it's a collection of a bunch of different type of things. And that's essentially what a fund is. And so a fund is a collection of investments. It consists of stocks, bonds, cash, or, you know, just a variety of different things in one. And the purpose of that, again, is to allow you to invest in a lot of different things with one investment. So instead of having to go out and research a bunch of different companies or whatever, you get to invest in a fund and the money is just split between the companies. So that's really one of the primary reasons behind it. And so there's really three main reasons why you would go ahead and invest in a fund in general, whether it's a mutual or index fund. The first reason being is diversification. And I know this term gets thrown out a lot when it comes to investing. People say, you want to diversify, you want to have different types, you never want to keep your eggs in one basket, that type of thing. And, that sounds cool, but when you think about having to go out and research this company and research that company and look up this bond and look up that bond, it's a lot that goes into it that the average person either doesn't want to do because it's boring and just like, all right, to hell with it, or the average person just doesn't know how to do. And so, instead of having to go out and research a bunch of different types of investments, you can invest in one fund and it's already diversified for you because, the part is already taken care of. The hard part's over with. The second part that goes right along with it is it's time saving. Unless you're just one of those people who likes investing or, they like looking into companies, they like reading financial statements and other boring shit like that. Unless it's just something that you like to do and you want to do, the average person would rather avoid it because it's not something that you can just open up, you can skim through it in a couple of minutes and it be done with. It's something that takes a lot more time than a lot of people would rather give. And so with a fund, again, you don't have to research all these individual companies because it was done for you when the fund was put together. You can just, invest in a fund, be done with it. And last is it removes emotions. And this is an important part because, when it comes to investing, the one thing that messes a lot of people up is they let their emotions control a lot of decisions. Whether it's they keep hearing about a certain product and they, their emotions inside them say, oh, well, this is going to be the next big thing. Like I have to invest in this and, but they don't know anything about how the company works and their financials or just anything like that. Or, you keep hearing about, oh, the stock market is dropping now because of everything that's going on in the world. So you're like, okay, well, I need to go ahead and sell now because I see prices are dropping or just, whatever the case may be. There's a lot of emotional decisions that people use when they're investing, which is not good. The key when it comes to investing is you try to eliminate as many emotions as possible and invest for logical reasons. If you invest in a company, it's because, they make a great product and they're making great money, they have great management or whatever it is that you decide to focus on. That's why you invest on it. And with funds, since it's not you out there picking individual companies and things of that nature, you don't necessarily have to rely on those emotions. You invest in a fund, it's done. You can kind of sit it aside and be done with it. And now this is the part that kind of separates the two. So that kind of sums up a fund as a whole. I'll take one quick break just to see if anybody has any questions in terms of, how a fund works or, the purpose of a fund in general before we get into the specifics. Okay. All right, that's perfect. So now that we know what funds are for the most part, there's two main funds out there that you're going to hear about. You have your mutual funds and you have your index funds. And the reason why they're so important is, even though they're both funds, they kind of work the same, but there's real important differences that you're going to want to know about because it's going to determine what you invest in going forward. So the three main differences you should know between them. One is the management style of them, as in, how are these funds run? The second one is, okay, so what's the objective of the fund? And we'll elaborate more on that here. And the third one is the cost. This goes without saying, but nothing's free. You know, when you invest in a fund or things of that nature, there will be costs associated with it, just like any other thing out there. So again, those are things that you want to kind of keep in mind. So to begin, remember, with a fund, it's a bunch of different types of investments. Again, you know, you have stocks, you have your bonds, you have, you know, real estate, you have cash, you have all these different types of investments that are put together in one fund. The main difference is mutual funds are put together by actual people. So that means, you know, if you wake up one day, you like, I'm tired of being broke. I'm tired of sitting on this money. I got it. Let me do something with it. I think I want to put it in a mutual fund. So when you go out and, you know, any mutual fund that you look at, each one that you're looking at was put together by people. So that means it was actual humans that went through and said, you know, I think company A, B, C, D, blase, blase, this bond, such and such. I think these will be good to go together in the fund. Let me package them together. This is called Fund A. You know, and they'll go through and say, I choose this company, that company, blase, blase, such and such, you know, whatever they choose. And they say, okay, I'm going to put this together. This is Fund B. So the thing is with mutual funds, anytime you see them, you know that it took somebody actually going out and putting that together for you to invest in, which is a key point later on, as you'll see. And the third thing, well, not the third thing, and the reason why that's important is because people put together mutual funds, but index funds don't involve people. And the reason for that being is index follows a certain criteria that's already predefined. So, for example, there's a very popular index fund called the S&P 500. And essentially what that is the 500 largest companies in America. And why that's important is because the criteria is already defined. This fund is the 500 largest companies in America. So that means it doesn't have to be a person that goes through and picks company A, picks company B, picks company C, because there's no reason to, because it's already defined. You know, you already have the 500 largest companies in America, whatever they are, that's just what they are. You know, nobody needs to pick those companies because it's already there. And so, you know, the criteria can be on size, for like the one I just explained. So the S&P 500, for example, is the 500 largest companies in America. Or you can do, you know, only small businesses or only medium-sized businesses, or you can, you know, they may put the fund together by industry. So it could be, you know, you can invest in a fund that only has agriculture companies in it, or a fund that only has tech companies in it, or a fund that only has retail companies in it, you know, or the criteria at this point, it varies widely. There's no really set criteria. You know, companies that put these together, you know, they can kind of base them on whatever they want to. You know, there's some funds who are put together with companies that only have, you know, women CEOs, or there's some funds put together of only companies that follow certain like green practices. And so, you know, whatever criteria, that can vary widely, but the key thing is that all those companies that are in the fund kind of share that criteria. And so, whereas a mutual fund, you had, you know, a person behind the scene that's picking all the companies that are in the fund. With an index fund, because the criteria is set, nobody has to pick those companies. There just is what it is. And so, for example, you know, the index may be the 500 largest companies in America, and what the index fund would just be a fund that consists of those companies. And hopefully I'm wording that in the right way that kind of connects with people, because as you'll see later on, a lot of that has to deal with cost too. You know, it's a lot cheaper when you don't have somebody who has to do this stuff. You have, you know, kind of systems in play for it. So again, mutual funds, actual people put those together. Index funds follow a set of certain criteria. So, you know, whatever companies fit those criteria, those are the ones a part of the fund. And this is just to kind of go through, if you see this slide, just kind of shows you how it works. And so for those who don't know, when you talk about size of a company, generally you're not talking about the amount of employees or the amount of stores or anything like that. You're talking about something that is considered the market capitalization. It sounds complicated, but essentially the easiest way to think about it is the amount of shares that a company has times their share price. So, if a company has 1 million shares out there and, their share price is $20, their market capitalization would be 20 million. The only reason that's important is for situations like this when you're determining size of companies. And, say, for example, just to go back to the S&P 500, again, that's the 500 largest companies in America. Say you have one company in there, company A, and their size makes up, 10% of the fund size. So, if the fund is $1 billion size-wise and one company, is 100 million, they make up 10%. That's how your money gets divided. So just to break it down. So again, say we have company A, they're 10% of the whole fund size. And if you invest $1,000 into that fund, that means 10% of that money goes into company A. And so why that's important is, again, if you have a fund and you have a lot of different companies in it, the money that you put into it, it doesn't go to each company evenly. So, if you have a fund with 20 companies in it and you put in $200, it's not like $10 goes to each company. Again, it's all based on the sizes of the company. So again, if you're looking at the slide that's up right now, say you invest $1,000 into a fund and one company is 25% of that fund, $250 of the 1,000 you just invested, it would go into company A. Or, if one company is only 1% of the fund and you invest $1,000, then okay, only $10 of mine is going into whatever company that is. And so that gets important when you start dealing with funds, again, that has a lot of different companies in it. Just to give you an idea, generally speaking, that's a little bit more detailed than what you would really care to know from a certain standpoint. But it is important to know that, your money doesn't get divided evenly. It's not, you don't necessarily need to know the percentages, or you don't necessarily need to know, okay, with 8% is going in this, 10% is here, 5% there, blase, blase. But you should be aware that it's not spread out evenly. And the second thing, oops, let me go back, went too far. The second thing is the purpose of the funds. And so, again, the purpose of the index fund is to just follow a certain criteria. Again, and I want to hammer that point home because that's very, very distinct difference between the two. Is index funds follow a preset criteria. And so, the objective of the index fund is to do just however well the companies in that fund do. They don't necessarily have anything to match up against. Their whole objective is, okay, this criteria, these are the companies, however these companies do or this fund does, that's just what it is. It's not like they have a comparison point, because you generally can't compare funds against each other because it's different types of companies. This one may be the largest companies and this one may be only agricultural companies, and this one may be, again, whatever criteria. So it's not like you can compare how this fund is doing to this fund because, it's a lot of different factors involved. So the idea of the index fund, again, is to just match however well the companies are doing. Now, the object of a mutual fund is to beat an index fund in terms of returns. And that's an important point because, with preset criteria, again, it's not much thinking into it. But the whole point of a mutual fund is, you have money managers and people who deal with money for a living, and you have investment bankers. And what their job is to try to put funds together though they're going to, you know, receive greater returns than an index fund. So, you know, for example, just to go back, because this is the easiest, you have the S&P 500, you know, the 500 largest companies in America. So that's a fund. Criteria is defined. It is what it is. You got 500 companies. That's just, oops, hold on one second. I'm sorry, I got technical difficulties with the screen. Okay, again, yeah, so just to rewind that back, the objective of a mutual fund is to try to beat an index fund. And when I say that is, again, because index funds are already put together to certain criteria, the reason why you have investment bankers and professional money managers and, you know, kind of people who do this for a living is, quote unquote, they're supposed to be smart enough and do enough research to be able to put funds together that have greater returns than, you know, index funds. And so, you know, if the average index fund returns 8% each year, you know, the goal of a mutual fund would be to return 10% in a year, which is really the only reason why they would exist. Because, you know, if there was no real incentive to go to mutual fund, then, you know, I mean, everybody would just stick with index funds. But when you go to mutual fund, you're basically betting on the people who put it together. You're betting that, you know, they knew enough of what they were talking about, that they can kind of beat the market, quote unquote. Is kind of the better way to put it. And the third thing that really separates them, and which is most important, is the cost between the two. You know, index funds are very, 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 very cheap. They're extremely cheap. You know, they're one of the cheaper investments out there that you can make, versus mutual funds is kind of the exact opposite end of the spectrum. You know, they're one of the more expensive investments you can make. And the reason for that being is the effort. Again, the index funds, since they follow a criteria, no work goes into play when it comes to choosing these companies. If the criteria is the 100 largest companies in America, nobody has to sit down and think about what the 100 largest companies in America are. You know what I mean? It's defined. Whatever the 100 largest are, that's what's in that fund. You know, if you do the top 10 retail companies, nobody has to sit down and think about, okay, well, what are the top 10 retail companies by size? You know, that's already defined. It's companies 1 through 10, package it together in the fund. There you have it. But with a mutual fund, again, you know, remember, it's an actual person putting that together. So this person has to research these companies. They have to research these bonds. They have to think about what makes sense to put together. And so it's a lot more man work and a lot more manpower that goes into it. So they have to charge more for these. You know, with index funds, you can just put them out there, they're good. But when you have somebody, or when you have companies and it takes labor, it takes time and things of that nature to put these things together, you know, they're going to make their money up on the back end. It's just kind of, that's just how it goes. And so that's the main separator between the two that a lot of people care about. And just for perspective, when you're dealing with funds, the charges, you're not charged, say, a one-time fee when you buy a fund. Your fees are based on however much you have invested, and it's called your expense ratio. And essentially what your expense ratio is just a percentage of the amount that you have invested. So, you know, say you wanted to go out and you wanted to buy shares in Amazon. You know, you would go out, you could say, all right, I want to buy 10 shares. During that time, once you place that order for that share, you know, you'll be charged one flat fee. You know, it could be free, it could be $5, whatever it is, that's just a flat fee. You're charged that, that's the end of it. But when you're dealing with funds, again, it's a percentage or however much you invest. So, you know, if you want to go buy a share of a company, it could be $100,000. You know, you may only pay a $5 fee. And if you want to go buy a share of a company that's $10, you know, you're still going to pay that $5 fee. So it's no real difference in that flat fee, you know, versus, again, when you're dealing with funds, it's important because it's a percentage. And so, you know, the percentage may not seem much on paper, but when people start looking at it long term and when they start realizing, okay, once, you know, you're starting to up your money a little bit and the amount you got in there, once that kind of rises up a bit, you start realizing just how important these percentages are. And so, for example, here are the average expense ratios of both. And so with an index fund, the average expense ratio is 0.09%. And so basically what that means, as you see, is for every $1,000 that you invest in an index fund, you only pay 90 cents in fees. And this is yearly. This is an annual fee. So it would be, you know, 90 cents annually. So, you know, if you invest $1,000, you can expect to pay 90 cents in a year. Mutual funds, however, as you can see, is more than 9 times that. You know, it's 0.82% fees for that, your expense ratio. So for every $1,000 you have invested, you know, each year you're going to pay $8.20 in fees. And so, you know, if you think about it, you have 2 separate funds, one index, one mutual. You put $1,000 in both. You know, in one fund, you're going to pay 90 cents to hold it. The next fund, you're going to pay $8.20 to hold it. And again, you know, when you hear about it like that, you're like, all right, well, you know what I mean? It's a little bit over $7, blase. It is what it is. You know what I mean? It's not enough to really make you stop and think about it like, oh, damn, like I'm actually spending a whole lot of money, like just by holding this fund when I don't have to, you know what I mean? It's not a necessity. It's eating away at the amount of money that you return. If you think about it, if your investments, you know, make a 10% return, but it's in a mutual fund, it's almost like it only made a 9% return. And, you know, and those percentages really eat up. And just for perspective, you know, here's the average loss over 30 years. You put the same amount in the funds, you know, let it have the natural returns, let it benefit from compound interest, and you don't touch it. In 30 years, you know, with the index fund, you would have paid about $1,800 in fees versus with the mutual fund, you would have paid about $15,000 in fees. And so, you know, when you tell somebody, oh, well, this, you know, about a percentage point off, that might not stick with them. Or, you know, if you tell somebody, oh, well, this, you know, like a $7 to $8 difference a year, that may not stick with them. But when you start talking about long term, and once the money starts getting higher and these percentages really start adding up, then people start to think, oh, okay, now I get it. You know what I mean? Now I have a bit more perspective on, you know, just how important the different percentages is. And, you know, and so when you're going out and you're thinking about buying a fund, the key is that, you know, you want to think, is it worth the fee? And if you're new to index funds or mutual funds, you're probably thinking like, I don't know. Like, that's why I'm on a call now to try to figure out, like, is it worth it? You're probably like that. Like, that's what we're here. We're hoping you tell you. And so long story short is generally is not. And for perspective, over the last 100 years, only 3% of mutual funds have beat index funds and returns over a 10-year period. So you can generally take any 10-year period you want to, like literally any span of 10 years you want to, and you can look at index funds versus mutual funds, and you can compare them. Any of those 10-year times, you know, 97% of index funds are going to have higher returns than the mutual funds. And it's a couple of reasons for that. First reason is it's hard to beat the market. You know, a lot of people think they're smart enough to beat the market. But, you know, when the market controls its own destiny, you can't really beat it. You know what I mean? You kind of, you're along for the ride and you hope you can take advantage where you can, you know what I mean? And that's the first thing. And the second thing goes back to human emotions and being irrational. Humans are naturally irrational people. You can see it every day. You can turn on the news. You can walk out. People are terribly irrational. That's just how it is. And you have to think about, okay, these mutual funds are put together by humans. Granted, they do this for a living, but at the end of the day, they're human. They have emotions. They're irrational. And a lot of times they're not as smart as you like to seem. You know what I mean? They throw a bunch of white dudes up in three-piece suits with MBAs somewhere on Wall Street, and they say, all right, put this together. And, Hunter and them boys, they sit there and they put them together during their binges. And like, you know what I mean? But it's like they're still human. There's still a lot of factors that go into place. And at the end of the day, again, you're always at the mercy of the market. And so what index funds does, it takes away that. You know what I mean? You have your criteria, you have your companies. That just is what it is. And again, you can kind of go along for the ride and you'll be good. And so I say all that to say is, and this is especially important for people who, they want to start investing, but again, you don't want to go out and research companies and, you rather watch paint dry than read financial statements or, there's probably a million other things you'd rather do than sit there and read through company financials and figure out, oh, I want to invest in this or blase. Is, to invest in index funds. Index funds are the way to go. Again, they're diversified already for you. It takes that out of it. They're extremely cheap. You know what I mean? It's about as cheap as it's going to get for you. And, it takes the emotions out of it. You can relax. You can breathe easy. It's like, just how you get paid and you put a percentage away in your savings account and it's just there. You're done with it. You know what I mean? Treat index funds like that. Put your money in it. Let it be done. And, let it sit and let that be what it is. Because once you start trying to, beat the market or make frequent trades and things like that, a lot of times people don't realize, that they're hustling backwards, is how I like to put it. There's no real need to hustle backwards. If you're out there and you're making a lot of trades and things like that with stocks and all that, you may have certain gains, but when you think about paying $5 fee per trade you made, you realize like, damn, well, I didn't really make anything at the grand scheme. And so like a lot of times I tell people is, you invest for a reason. It's the difference between investing and being a trader. And you want to invest. So, be comfortable with putting that money in the index fund and, not needing to touch it in case of emergencies or whatever. But just trust that that's money that you can put away, very little thinking, but you'll reap your benefits from it. And so like, if you're at that position where you're debating between index funds and mutual funds, and that's why a lot of tell people I would say, okay, well, do you know the person who put this fund together? And I'll say, no, of course not. I just know the company. And I'll say, okay, well then, do you trust that person? And you're like, okay, well, how can I trust a person? Because I don't know them. Once you start asking people like this, they start to realize, okay, like, is you rather not put your trust in somebody's decisions to put things like that together for you. Go with the index funds. They're cheap. They're reliable. They're one of the better products out there. I'm sure y'all are familiar with Warren Buffett. He praises them a lot, and for good reason too. Nobody wants to you don't want to have to stress about your investments. The point is to make money while you're doing other stuff, making money. You want that to be kind of a distant thing. You want to put it there, you want it to make money, but it doesn't want to be something that you want sitting on the back of your mind or that you feel as though, oh, I have to check on how the price of this business is doing today or the price of this business is doing today. You want to kind of eliminate that from your mind, especially during times right now where people have a lot of real shit to deal with. This isn't something that you should be wanting to stress. So this kind of takes off that stress. It takes the thought process out. It lets you put your money somewhere that you can trust for the most part. And, you can trust it long term. It was the right decision to make. And so that will be the end of the comparison there. Up on the screen, I've put up my finesse and finances socials. I'm sorry. We produce a lot of dope content, and we take a lot of culture. We use hip hop. We use a lot of different ways to kind of connect people to financial literacy and kind of getting topics out there. So, it's real dope content. It's black as hell. It's authentic. It's something a lot of people can relate to. And it's something that, you don't typically get when it comes to personal finances. And I know Dorian's asking me to kind of just share a little bit about my story. So I'll just give like kind of a quick run through of just, why this is even important to me. And it really just kind of began, after I graduated from college, started working, started making some decent money. But then I realized, just how much I didn't know about money. And so, I knew how much I would bring in a month. I knew how much my bills were a month, but then, I got my white homies over here and they're talking about money kind of a different way. And, people here who were a little bit more affluent, they're talking about money different ways. And I'm starting to think, and it kind of came up to me like, damn, like I don't really know as much about personal finances I really need to know. And a lot of times that's the problem, because a lot of people don't realize what they need to know until it's time to know it. And generally by then, it's a tad bit too late, or you wish you had known it way before then. And so I was going out, reading, researching, trying to learn the information, picking a lot of it up. And it was just kind of to the point where I was just keeping it real with myself. I was just like, damn, like this information is dry, it's boring. Like, this is brutal. Like, I see why people don't go out their way to learn this information. Like, I wouldn't either. Like, and so I was like, I think it would be dope if I can kind of, add a twist to it and take this, traditionally boring topic and, kind of flip it around, make it entertaining, add some cultural references into it and, just make it something that people actually want to learn about, or, at the very least, it sparks their interest enough that the subject is in the back of their mind. And, later on down the road, they may think, okay, I heard about blase, or different things like that. Because, a lot of people, money is like a taboo topic growing up. Especially in my household and a lot of other Black households. It's like you start talking about money, first thing your parents gonna tell you is like, stay in a child's place. Like, you're not concerned about what financials and different things like that. So you don't grow up knowing about credit and all these different type of things. You know what I'm saying? That's usually something that you learn once you're an adult and once you need credit. A lot of people don't know about credit until they go apply for some utilities or something and somebody does a credit check and, they don't have any credit, and that's a whole nother ball game. And so really I just kind of wanted to add a different twist to the topic and, present it in a way that people don't usually get it. So at the very least, it's entertaining. You can take it in and you can kind of, finesse your finances, as I like to put it, because, it's not really as hard as a lot of people like to make it seem. If you can break down the topic and actually present them in ways that people can relate to, you'd be surprised just how receptive people are. So it's not like investing in things like that are just some overly complicated subjects. You just have people who like to stroke their egos. They like to use bigger words. They like to, give you runarounds and play gatekeepers of the investment world and things like that. But, once a lot of people really understand the fundamentals and how it works, you can break it down and get used to it a bit. So I put up a book. I wrote a book called Finessing Finances, a freshly entertaining guide to personal finances.
Stefon?
Yep.
Oh, sorry about that. I think we have a few questions.
That's perfect.
In the group chat. I just wanted to just see somebody ask. Just want to say thank you again for your presentation and also sharing a little bit about your background. And we have we're going to be sharing these slides with our members after the meeting. We just have one question on the group chat from Falarin Aluko. He mentioned that mutual funds have lower returns than index funds. Can you clarify that? How mutual funds have lower returns than index funds?
Okay, so generally, and when I say returns, I'm referring to, if a fund returns 10%, you invest $1,000, after a year, you can expect to make $1,000 on it. And generally, when I say index funds, have higher returns than mutual funds, it's really dealing with, again, if you use just those numbers right throughout where you have the index funds and those on average return, 8% a year, 8 to 10%, that's the average. And when I say that they, have greater returns than mutual funds, obviously it's not like one specific fund versus another, but more so, the funds in general. And a lot of that, outside of just the percentage returns where, the average mutual fund returns, 7%, the average index fund returns 9%. You also have to think about the fees that you're paying on top of it. And so, even though your mutual fund may be returning 7%, you're paying almost 1 percentage point in fees. So, that 7% turns to 6%. And so even if, the index funds and the mutual fund are going at the same pace, the returns are going to be greater by the fees alone. But outside of that, generally speaking, as a whole, index funds and mutual funds, when you're looking at them historically, index funds have way greater returns over the long term. Hopefully that was a little bit more clarification on what I meant by that.
Yeah, thank you, Stefon. And please, if anybody on the call have a question, please unmute yourself and ask your question, or also you can also type your question in the chat box. So if you have any questions, please feel free.
Yeah, I have a quick question. Stefon, thank you for taking your time to answer, presenting to us today. This is Abib. Thanks for, telling us about index fund and then the mutual fund. Is it possible then you can just quickly touch on ETFs? And then I would just want you to mention to everybody that, if we want to trade any index fund, index fund will be priced at the end of each market, so that just so some people probably don't know that.
Okay, so I got the first part about the ETFs. Can you say the last part of the question again?
Saying that the index fund, if you want to trade any index, it will be priced at the end of the market, at each market.
Okay, that's a good point. So I'll go ahead and start off with ETFs. And for those who aren't aware of what an ETF is, that basically stands for electronically traded funds. And essentially, if you're aware of how the stock market works, it's essentially like an auction. You have buyers, you have sellers. You have people that are selling their stocks, you have people that are buying their stocks. The more sellers, if it's more sellers than buyers, the price drops down. If it's more buyers than sellers, the price goes up. So it's the typical supply and demand dynamics of the stock market. And essentially what electronically traded funds are, or ETFs are, those are funds, like the same funds we've discussed, throughout this whole thing. So, those are funds to put together. The only difference is these are traded on the stock market. So if you think about, let's say, let's take shoes, for example. And you can, if you were going to buy an index fund from a company, it's like you're going in that company and you're buying the shoe from the company. You know what you want, you buy it from the company, that's the shoe, you have it. That's like, if you're buying your index fund. Versus ETFs, when you trade them and think about it almost as if, again, it's like an auction. You think about it like an eBay type of thing. Instead of you going and buying this fund from a company, you're buying this fund from somebody else who wants to trade it. And so, these funds are traded between people. They're traded just like stocks, just like you can go and buy 5 Amazon stocks or whatever. You can go and buy 5 ETFs or something. And so that's really the main thing that separates them, which is important because, the prices of an ETF, because they're traded on the stock market like funds, this prices is determined again by supply and demand versus, you know, when you have index funds or things like that that are bought from companies, their prices are based on the prices, like the stock prices of the companies in there. And what he pointed out is, so you say, okay, so how are these priced? As y'all know, the prices of stocks, they fluctuate up and down all day. Literally all day they go up and down. So at the end of each day, which would be, you know, I believe 5 p.m. Eastern time, you know, that's when the markets close here in America. And once that happens, you know, the markets shut down. Okay, and you say, all right, these are the prices of all these companies in the fund. You know, the price of company A, B, C, D, blase, blase, these are the prices to it. And, you know, based on those prices at the end of the day, that's how the price of whatever that fund is calculated. So, you know, your regular index or mutual funds, you know, those are priced like that. But again, an ETF, which is a fund that's traded between people, you know, it's traded on the stock market. Again, those prices are based on supply and demand. So hopefully that's a little bit more clarification on that. And again, I'll go back, so y'all will have this slide. But if you have any specialized questions or anything like that, definitely shoot me an email. You can send it to the hello@finesse&finances or Stefon@finesse&finances. Either way, you know, I don't mind answering questions. And then, you know, if you have specific questions for your specific situation, you know, you can kind of get a little bit more personalized advice on different things like that. So definitely, you know, if you have a question here, if you don't feel comfortable asking it, or if it's one of those things that you run into later along the line, definitely send out the email. We generally get them answered pretty fast and pretty efficiently.
Yeah, thanks, Stefan. Stefan, we have another question on the chat box from Bookie. She said, "Is there a penalty for taking funds out of the index funds before the scheduled maturity date?"
So index funds don't have maturity dates. Like I know a lot of people, like if you're familiar with bonds and different things like that, you know, when you buy them for like a set period. Funds, on the other hand, you can kind of view those as stocks. And I say that as saying is, you know, it's not like once you buy a fund, you wouldn't cash out. It's like, hold on, let me run that back. So with the funds, if you kind of view them like stocks from a sense that, you know, once you buy it, you have it, and it's yours. So it's not like, you know, you have to keep it for X amount of time. It would be a matter of, okay, well, you say, all right, I need the cash or whatever. So you would sell it, or as they say, liquidate it, and you would do it that way. But it's not quite like a bond where you buy it and, you know, you have to hold it for 1 year, 3 years, 5 years, or different things like that. You know, you kind of buy it for the price is, and the risk is all in, price dropping or the price rising. So you can kind of sell it at any point during that time without any penalties or anything like that. There's no penalties or anything for selling.
Yes, just another question. I'm going to combine two questions. We have a question from Temi and also from Vera. One question for Temi was, what are some examples of good index funds, and what is your take on ETFs?
Good questions. So the first index fund, and if you've been on, you probably heard me hammer this one down, that I encourage people to look into is the S&P 500. And the reason being, again, is those are, you know, the 500 largest companies in America. And so when you hear people talk about the market or, you know, things like that, those 500 companies kind of drive the way the market goes. And, you know, historically, even though they have down years, because they're such a large driver of the market, you know, historically, you can kind of count on them going up. Because that's just how the market moves. You know, they have down years here and there, but, you know, I mean, historically, it always rebounds. And so when you invest in a fund like the S&P 500, you know, you're investing in stable companies. They're that large for a size, and you're basically you're betting on the economy at that point. It's not very, you don't have to worry about specific industries or, specific sizes or anything like that. You can kind of trust that to be a driver, and you can kind of, long term trust that to produce anywhere between, 8 to 10% returns over a long period. And in regards to ETFs, I don't personally trade ETFs. I want to make that disclaimer before I throw it out there. And that's generally because I don't like being as concerned about, daily fluctuations and things like that of the market, and how that influences prices and, just kind of the whole auction style of the market. And so, instead of kind of playing that auction style game in the stock market, I kind of rather, buy an index fund at whatever this price is, or, at predefined prices. Because, once you're dealing with the stock market and things like that, and you're dealing with supply and demand, then you're dealing with, you're going back to dealing with human emotions again. Because, if you have a whole bunch of people panicking, then you have a whole lot of people selling stocks and things like that. And then, you have the price dropping. Or if you have a whole lot of people who are thinking, oh, well, I think this is going to grow up, and you have a lot more people buying stocks, and then you have the price rises. And so it's a lot more like volatility when it comes to ETFs, because, you're dealing with that kind of push-pull effect. And so I kind of prefer to go the index route because, it takes that part out of it.
Thank you so much, Stefan. We just have another question from Urumila. She mentioned, when you buy these funds, can you contribute to it occasionally or just a one-time thing?
You can definitely do it occasionally. And so there are some companies, Fidelity, which probably be the most popular example, where you don't even have to buy the full fund. So for example, if the price of a fund is $300, you don't need $300 to invest in a fund. You can put in $100. You can put in $200. They let you buy like percentages or whatever, like portions of it. And so, with that being said, it's not like you have to wait like, okay, all right, I'm gonna wait until I have $300 and then do it each time. So as you get more money, you can kind of throw it in there. Again, a lot of them, some companies will make you have to buy them whole. So, if the price is $250 and you only have $200, you couldn't buy one until you had $250. But you can, with the companies like Fidelity, where you can buy partial, you could even do it when you say, all right, well, $100 every paycheck, I'm just gonna put it in there, and you treat it like a savings account, essentially. That type of thing. And so, yeah, you don't need to, you can put all your money into it as you want, however you want. And then, and say if you want your money back, you can sell a whole fund, or if they allow partial, you sell half your fund, or just however that percentage you would prefer.
Yes, thank you, Stefan. We're running out of time, but if it's okay with you, can we ask just one more question on the chat?
Oh yeah, absolutely.
All right, so this question is from Quaz. He mentioned, which is better for S&P 500 indexing, SPY or VOO? The former is more popular, and the latter has a third cheaper expense ratio. What is your take?
Say that last part again.
It says the VOO has a third cheaper expense ratio. What is your take?
I personally deal with SPY, and that's more so because they're more common. And that's actually a good point, because again, the S&P 500 is an index, but you have different companies. So you have Fidelity, E-Trade, Robinhood, companies like brokerage companies where you can buy these things. Each one of those companies puts together those funds. And so, the S&P 500 is the 500 largest companies of America. And so Fidelity would have their own S&P or own fund that mirrors the S&P 500. And then E-Trade would have their own fund that mimics the S&P 500, and Robinhood or blase, so on and so on. And so the SPY are more common between companies, and they're a lot more stable. So it's easy to compare them between different companies. So, you know, you can compare the rates between Fidelity and E-Trade versus whoever with that, because they're a little bit more comparable along the lines. If that makes sense.
All right, thank you, Stefon. Doing, if you want to close out the meeting, please go ahead.
Hey, Stefan, thank you so much for that wonderful presentation. I think, you know, thank you for your time. I think everybody learned a lot. I personally learned a lot from this. Also, thank everyone for being with us today. Really appreciate the time. I just want to say, I really love what Stefan does. I'm a fan of his work because, like he said, you know, finances is usually difficult, like, you know, the terms. But the way Stefan puts it is very simple and makes it very relatable to people like us. For example, I'm going to pull one of his posts he put up. I'm going to just read this. It's a line from Lil Wayne that Stefan put up, and he said, this from Lil Wayne, one of Lil Wayne's song. I said before you spend $1, boy, put up the re-up. That's a line from one of Lil Wayne's rhyme. And Stefan went ahead and explained this. And Lil Wayne is speaking on putting up essential money before making any purchases. When you get paid, always try to pay yourself first. So that's something we hear all the time, pay yourself first. But people always ask, what does that mean? But for Stefan to be able to put that with something Lil Wayne have said, it makes it very relatable, something everybody knows about. So I'm just want to say I'm a big fan, and thanks for doing that. And before we go, Stefan, I would like to ask you to give us one, this is our last segment. We call it the common sense finance tip. So anything you have for us as a common sense.
Okay. Yep. And so the last thing I believe for the common sense tip is to know how your credit score is calculated. And so a lot of people don't realize this. So your credit score is made up of 5 things. The first thing it's made up of is your payment history, and it makes up 35% of your credit score. The second thing it's made up of is your credit utilization. And essentially what that is of all the credit you have available to you, how much are you using? You know, if you have $1,000 credit line and you use 200 of it, you know, your credit utilization is 20%. The object is you always want to keep that number below 30%. 30% is the sweet spot when it comes to that. So credit utilization is also 30% of your credit score. Next is payment length or credit length. You know, how long have you been dealing with credit? That's 15% of your score. The fourth one would be your credit mix, you know, the different types of credit, whether it's mortgage, credit cards, phone, utilities, or however. You know, your credit mix is important. That's 10%. And the last 10% basically comes or what are called hard inquiries. And what those are basically, you know, how often do you apply for credit? You know, if you have somebody out there who's applying for a bunch of credit at the same time, that's a red flag because it seems like they're in financial trouble. And so those are the 5 things I want y'all to take into consideration. Those are the 5 things that make up your credit score: payment history, credit utilization, credit length, credit mix, and your amount of hard inquiries. So those are the 5 things that make up your credit score. Pay close attention to them. You know what I mean? Especially as Black people, we're already a little bit disadvantaged when it comes to lenders. They're not as friendly with us. You know, they're not as accepting. And so, you know, credit is one of those things that really our community needs to hammer down a little bit on. So that will be the parting words of wisdom.
Thank you, Stefan. I really appreciate that. So once again, thank you everyone for your time today. Once again, this is African Business Club. Our goal is to normalize financial literacy and promote collaboration among Africans through networking, education, and sharing of ideas. The conversation doesn't have to end here, so please join us on social media. We're on Instagram and Facebook at African Business Club 2020. And also, please subscribe to our YouTube page. You can like, share with your family and friends. The YouTube page is African Business Club. Also, we have the hashtag of the week. The hashtag is just for us to, because the social media is full of a lot of good and bad information. So we like to encourage people to go on social media and just filter through good information. So the hashtag of the week for this week we've chosen will be mutual fund. So that's mutual fund. So just randomly go on your Instagram, put mutual fund, hashtag it, and any good information you find, you can tag us at African Business Club 2020, and we can repost it, give it a shout out, and just for us to learn, some information while we're going on through the week. So with that said, thank you everybody. And lastly, let's remember we are all kings and queens. So let's treat each other as such. Let's encourage each other, respect each other. Thank you everyone. Peace and love.
Thank y'all for having me. Y'all be blessed.
Thank you.
Stefan.
Bye.
Y'all.
Thank you.
Thanks, Stefan.
Yep, much
Thank you. Nice one, Louis.
Thank
Nice one. It
you.
was a great
Bye.
session. It was a
Thank
great
you.
Thank you, sir.
Thank you.